Central banks never ease into an oil shock. Doesn't happen. When you have an oil shock, it's a very difficult scenario for basically policymakers to respond to because it both increases inflation and decreases real growth. I think a lot of people are getting ahead of themselves on talking about the disinflationary impact of an oil price rise. The first step is prices go up, real spending goes down, and that's where we're at right now. It has to get bad before someone does something about it in order to make it fun. People are kind of looking through the has to be bad in order for something to happen and just assuming everything will be okay forever. And that's just not how markets or economies certainly have worked over the last 100 years.
Hello, Breakdown listener. This is your host, David Canellis. We're taking a small break as we prepare to roll out a new season, so for now, please enjoy this recent episode from another Blockworks podcast, Forward Guidance, all about the impact of oil shocks in light of the Iran war and the situation with the Strait of Hormuz. So, enjoy the insights into macro, and we'll see you again for the breakdown soon. This episode is brought to you by Nexo. Step into a new era of digital wealth. Earn interest on your digital assets, borrow against them without selling, and trade all in one platform. Get started at nexo.com/breakdown. Quick break before we continue. Blockworks' flagship institutional conference, Digital Asset Summit, is back in New York City this March 24th through 26th. DAS brings together allocators, asset managers, policymakers, and the builders actually shaping crypto's next phase. Not the hype cycle, but the infrastructure and capital behind it. This year's summit represents over $4 trillion in assets under management, with more than 150 speakers and 750 institutions in attendance. Speakers include leaders from firms like BlackRock and Franklin Templeton, senior policymakers and regulators. Don Wilson of DRW will be there, alongside core crypto infrastructure teams across Bitcoin, Ethereum, and stablecoins. If you're looking for a serious institutional grade view of where digital assets are headed in 2026, this is where that conversation happens. Use code BREAKDOWN200 for $200 off. Learn more at blockworks.co/events. Now, back to the show. Nothing said on the breakdown is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are opinions, not financial advice. Hosts and guests may hold positions in the company's funds or projects discussed.
All right, everybody, welcome back to another episode of Forward Guidance. And joining me is one of my favorite repeat guests, Bob Elliott of Unlimited Funds. Always one of the best folks to get on to understand high-level macro frameworks and how it impacts the world, the economy, markets, everything in between. Bob, always great to have you on here.
Great. Thanks so much for having me. I feel like when we tried to find a good time, which was a few weeks ago, the world was a very different place than it is today. So we'll just roll with the punches and talk about what's going on.
Yeah, honestly, probably silver lining that, we were planning to do this a few weeks ago and then it got delayed. And now we're in a completely different situation, completely different conversation that we're about to have. So at least we're in amongst it now. We're going to try and put on our geopolitical hats on a little bit and try to figure out how to understand everything that's going on with the Iran strike and how it impacts the global economy. So you've been writing a lot on your Substack, which is really great. You've been writing a few different pieces on how to understand the context of this oil shock, of the Strait of Hormuz being closed and its impact on the global economy. And yeah, like I said, you're really excellent at these high-level macro frameworks. So I just want to understand to you, when you see something like this happen and you contextualize it with where the global economy was heading into this supply shock, what does it look like? How are you understanding this, and how does it relate to different oil shocks that we've had, like the 2022 one, and even the 08 one? Like, we had a pretty significant oil spike back then that led into a recession. So yeah, walk us through how do you digest something like this when it hits?
Yeah, well, I think we were coming into the beginning of the year experiencing something that I called the savings-driven economy, which I sort of describe in contrast to what was for many years post-COVID an income-driven economy. And what I mean by a savings-driven economy was we started to see basically that spending continued to hold up and investment continued to hold up, despite the fact that it took more to savings from households to keep that spending going as labor markets weakened, and more to savings from businesses to keep their pace of investment, particularly related to AI and such, alive. And so that's sort of the premise coming into this, which in many ways created an economy somewhat on a knife's edge, meaning if things had gone well and the government had, was pursuing modestly expansionary policy during the year and asset prices lifted a little bit, we were probably going to at least meet those sort of expectations. maybe even do a little bit better than the expectations that sort of was out in markets at the outset of the year. I think the challenge is when you have an oil shock, it totally rewrites the conversation. And the reason why that is because um, it's a very difficult scenario for basically policymakers to respond to because it both increases inflation and decreases real growth. And as a result, policymakers are kind of stuck in that sort of environment. And part of the challenge is when we were coming in, we had already had a lot of savings sort of baked in the cake. And so there's not that much room for additional savings to be applied in this circumstance. Doesn't mean it's impossible or the households won't save at all. It's just we're in a very different environment now than we were, say, if this happened 2 or 3 years ago. And so I think the challenge is basically for households and in particular that were already spending more than they were earning to saving relatively rapidly. Now you've basically add another 1 to 1.5% price hike across their basket of goods to households that were already spending at only about 1.5% to wrap up the year in real terms. And that basically means household consumption is likely to fall to zero in real terms. And for an economy, US economy that's so reliant on household consumption to keep it going, zero real household consumption is pretty antithetical to expectations of growth of 2 to 3% that we've become used to.
Mhm. Yeah, so contrasting that with 2022, back then we had probably one of the hottest labor markets we've ever seen. Like job openings were just absurd. And so I'd love to just hear, back then when we had that one in 2022, it seems like we narrowly missed a recession on its own. Some people debate the semantics that we did see a little one, but whatever. The fact is that we came out of that somewhat unscathed. And it feels to me like that is because, yeah, the labor market was in an excellent place. People were stuffed with cash from COVID era stimulus. Companies had plenty of cash as well. Things were good, and we narrowly avoided any sort of major issues there. I get the feeling that, yeah, consumers and households, like you said, are in a very different situation right now. So I'm curious, like when you see something like this oil shock that leads to higher prices and then lower consumption, how at risk are we today versus 2022?
Well, I think 2022 is really helpful because to study it helps you understand all the different mechanics. So what happened, while the magnitudes are slightly different, the mechanics are actually super similar in the sense of going into it, we had a period of elevated inflation, that was sort of underlying the economy. Now, of course, that was related to COVID shocks and it was at a higher level versus today, which is essentially tariff related plus in terms of inflation dynamics and at a lower level. But that sort of kindling that existed of elevated inflation in the economy before the oil shock existed in both places. In both places, we had actually basically the same size oil shock. If anything, this oil shock might be larger based upon just what's priced into the curve. So, leaving aside whether you believe that that's good pricing or bad pricing or whatever, if you just basically take the curve as the market price and the future path of oil prices, this one's actually going to be a bit higher. The 22 oil shock largely resolved within a year, meaning it started at the beginning of the year, it peaked first in March and then in the summer, and then it went back to basically where it was to start the year. Right now, oil prices are projected to be 40% higher at the end of this year than they were at the beginning of this year. So that's a more extended oil shock. And in that 2022 case, basically what you saw was uh, inflation continued to be elevated. Fortunately, nominal earnings growth was relatively strong during that period, particularly when you add in all the transfer payments that were still sort of in the system. It allowed households to save in response, to maintain their nominal, to maintain their real spending to some extent, but you still saw a reduction in real spending. And so those in the 22 period, if you just think about each one of those levers, it was like household spending was strong nominally, right? So picked up nominally, financed by saving, but real spending fell. And that's a perfect example of this combination that I'm describing that comes with an oil shock, which is both prices rise because people save in order to keep up their real spending as much as they can, and real spending falls. So it's really hitting essentially both sides of, say, the Fed's mandate. And what did we see in response from the Fed? Now, of course, it was sort of the unlucky outcome that forced the Fed's hands to transition from basically the transitory narrative to the not transitory narrative and hike a whole heck of a lot in response. And today, what we're seeing is, at least so far, we've seen an unwind of expectations of easing to basically neutral policy. I think the real question is actually the next set of policies likely to go higher, because this will be enough to sort of force the Fed's hand. Certainly in neither case did we see the Fed cutting into an oil shock, right? We didn't see that at all. We saw the exact, at least back in 2022, we saw the exact opposite.
Step into a new era of digital wealth with Nexo, the premier digital assets wealth platform. Earn interest on your digital assets, borrow against them without selling, trade a wide range of cryptocurrencies, all in one place. Nexo is now available again in the US with an evolved product suite tailored to today's market. For a limited time, new US clients can unlock 30 days of exclusive Wealth Club Premier benefits, including enhanced interest rates, reduced borrowing costs, and up to 0.5% crypto cashback on trades. Get started today at nexo.com/breakdown. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
Okay, so if we just think about like a matrix of the quality of the economy going into these shocks, so you have the current one, you have the 2022 one. I'd love for you to also unpack what happened in '08 and what was the quality of the economy back then going into it, because obviously that one we saw oil prices surge, and then we just had one of the greatest, the Great Recession, and oil prices crashed afterwards, and there's this whole demand destruction there. So I just love to add onto the matrix here of what did it look like in '08 and how did that sequence of events look like?
Well, I think interestingly in the '08 cycle, there was obviously a huge surge in oil prices. I mean, more meaningfully than we're seeing right now. And it was predominantly driven at the time by a tight market intersecting with relatively strong demand from the emerging world. There's the for those folks who are back around that time, there's this whole idea of a global decoupling, right? That maybe the US was going to face some pain related to its housing problems, but globally we were going to decouple and it wasn't going to be a problem. And the reality was at that time that the sort of global growth narrative, or the narrative of, or the data outside the US, was quite strong. And it was only when the credit problems emerged in the US that created the second and third order consequences through the US, the economy, and the financial system that we saw a withdrawal of capital that basically crushed the emerging markets and created that reduction in demand. And so in some ways, I think I think people who are not sort of living through that period might confuse that period as indicating a strong U.S. economy, or even that oil price rises were a meaningful driver of the
Hmm.
economic slowing that occurred. And they were pretty marginal. It was pretty fast. It was pretty marginal. And the big story there was the credit problems, because I mean, the credit problems were like, the credit problems nearly ruined the entire financial system. So I mean, it was just
Hmm.
like orders of magnitude more important for the economy in the U.S. But what it did highlight was just how tight that market was and how reliant it was on emerging markets, who then were sort of the ancillary, took sort of the ancillary hit from the U.S. financial problems.
Got it. Um, Last historical analog I want to ask you to contextualize the situation, and I know I'm really testing your financial history, but you've also written a lot, studied a lot of big macro cycles, so I feel confident you can answer this one too. The other one is, of course, the 1970s oil shock and what happened there. Obviously, that one was the great inflation that also ensued in the '70s. So, yeah. Lastly, just love to understand what was going on there and how is it different from today.
Yeah, I think in many ways the linkages are similar to today, but the magnitudes are very different. And so I think that's, people often try and draw analogies of magnitude, and analogies of magnitude are kind of silly because, so for instance, back then oil prices went up 4 or 5x, right? Okay, so oil prices today are not going up 4 or 5x, so we're not likely to see the same sort of magnitude of inflationary pressures in the economy. But what that doesn't mean is, that doesn't mean that the linkages are to be ignored. The linkages are the same exact linkages at different magnitude. And so in that case, you really had, in a lot of ways, I had talked about the sort of post-COVID period, I think, as being very similar to sort of that late 60s environment where you had sort of persistent inflation that was gradually creeping up, large fiscal expansion, large deficits, not much credit driving the economy. That's why I think the late 60s is actually really not much sort of household credit or corporate credit or borrowing driving the economy, a very income driven expansion that eventually got to a point where we had an oil shock, and that oil shock created a lot of pain in the economy and created a lot of inflation and pain. And then we had another oil shock on top of it, right? And so I think it's a good analogy in the sense of sort of similar kind of kindling that existed, meaning like inflation was a little too high for a little too long, an oil price rise occurred, and then that created basically the conditions that we saw in 22 and likely to see here, which is rising prices and weakening real demand and real activity, creating a challenging circumstance which sort of forces the central bank and the Fed into tightening, even though it's kind of an unpleasant tightening given the set of circumstances that existed.
Mm-hmm. Cool. All right. So coming back to present day, we have an economy, as we mentioned in the last few months, was largely driven by this savings. So savings rate coming lower, and yeah, I want to contextualize that with what you're seeing in the health of the consumer in terms of its spending potential and what the incomes were looking like going into this. And so you mentioned that the current oil market is pricing in a crisis that is more extended than the 2022 one, leading into this situation of an economy that is on a knife's edge, largely held up by savings. And when you put that all together, how do you see things playing out from here on?
Well, I think coming into this, it's good to just start with the baseline dynamic, and sometimes macro folks will try and make an economy more complicated than it is. Like the U.S. economy is basically households earning money and spending, like to oversimplify. And then there's some other stuff that goes on, but that's basically what it is. And so when we were coming into this, let's call it through January, household income growth was growing at about 3.5% or a touch better than that. How was that growing that way? Essentially zero employment growth and 3.5+% wage growth year over year per worker, right? That's how you get that nominal wage growth. US households were spending at about 5.5% coming into it, on a 5.5% growth coming into it. How do you close that gap between those two things? Well, essentially, it's just mechanical. The savings rate has to fall in response to that, or transfers have to pick up, but transfers have largely been the same through this period. And so what you see there is you basically see that gap widening and widening, which is the labor market's weakening gradually. No acute crisis, nothing crazy, just kind of gradually weakening. Spending trying to stay up as much as possible, driven by that savings rate. And then if you sort of work through those numbers, we had 5% nominal spending growth in an environment of 3% inflation, which led to 2% real spending growth. Okay, now let's fast forward. Introduce the oil shock. How does that change things? Well, the labor markets aren't going to really change in the next day or two. It's just the labor markets are like watching paint dry. They just basically can carry on as they are, right? I mean, slowly but surely might move in one direction or another. But basically, what we're going to see is 3.5% wage growth, real spending growth. The question is, okay, let's just say they keep saving. You keep that 5% nominal spending, but now we've gone from an inflation environment of near 3 to an inflation environment that's going to have a 1 to 1.5% increase, and therefore real spending is going to fall. Those are the numbers. That's the sort of the household math problem, I always call it. If anything, the risk is that households might hold back on their savings to some extent, right? What I just described is that they continue to save. They continue their pace of savings, or the savings rate continues to fall. If you have an environment where stocks are falling or there's more uncertainty or more concern, you might actually see households no longer choose to increasingly save, and they might pull back on that and bring their spending in line with income. That would be the biggest risk, because then we'd go from a 5% nominal spending growth environment to, say, a 3.5% nominal spending growth environment in the context of inflation that could be in the range of 4%. And that's where you get negative real spending growth. And that creates the second and third order effects on labor markets and incomes in the future. But we're kind of getting our head of ourselves on that. I think a lot of people are getting ahead of themselves on talking about the disinflationary impacts
Yeah.
of an oil price rise. The first step is that prices go up, real spending goes down, and that's where we're at right
Yeah, I think yeah, that was a nice little segue into how do people try to understand the sequence of events here, especially if something like an oil supply shock, because you look at something like '08 and it's like, well, look, you know, central banks should have looked through that and been like, oh, shoot, there's this huge negative growth impulse on the other side of things. So now you have everybody skipping the first step and saying, we got to go straight to cuts. And then contrasting that with what so far the reaction from central bank pricing has been mostly hikes or at least less cuts in the case of the US. So we'd just love to understand, how are you thinking about monetary policy within this context? So you have, like I said, the US curve is, we had a few cuts, now we're down to like one, maybe zero. Other countries are looking at even beginning to price in hikes. And people will look at that and say, hey, look, we should move to the next phase of things, which is beginning to think about cuts, because this is obviously going to be really bad for growth. But obviously you need the first to get the second, and I feel like that just needs a better explanation. So I'd love for you to unpack that.
now. Yeah, I mean, I was writing last night, having gotten a lot of comments about how oil shocks are deflationary or disinflationary, and the answer is like, of course, um, reducing household purchasing power through higher prices can be disinflationary, right? But the question is, how does that how does that system work? Because what has to happen is, the first step is you have to have the prices rise, which eat into the real demand capability of the household, which then creates the slowing of labor market growth, which then hurts nominal incomes, which then reduces nominal spending, that then has an effect on overall prices. Like, that's the path. And as anyone who's watched the labor markets through time knows, labor markets do not move that fast. Like, the labor markets are boring. We try our best,
Yeah.
the first Friday of every month, to make this thing exciting. Like, the reality is, they are boring as hell. And so don't forget that they take forever to play out. If we had a reduction in say tomorrow, real household spending went down to zero or started to contract, it would probably be 9 or 12 months before we would fully feel that effect in the labor markets. And so the point is, you got to focus on first things first here, as in terms of how this is likely to play out. And the first step is, you're going to have those price rises. And so central banks, I think part of the story, getting back to your sort of the core of your original question, which is, how do central banks respond to this stuff? Like, central banks don't ease into oil shocks. Go back, look through all of time at all central banks and how they've responded every single time. Like, who cares if you think it's a good idea or not? Like, I don't really care as a market participant, as a fiduciary. Like, how you think they should respond is a totally irrelevant way of thinking. A lot of people spend time on it. It's totally irrelevant. It's useless. It's distracting. Central banks never ease into an oil shock. Doesn't happen. And so what are we seeing right now? Well, we're seeing what you'd largely expect, which is, if oil prices are going to get, I don't know, a 1 to 1.5, maybe 2% inflation pressure through these economies, a little less in the US, a little more in places like Europe and the UK. Yeah, that's probably worth, I don't know, a couple of hikes over the course of the next year, meaning either going from from two cuts to zero, or from no cuts to two hikes. That seems like about right if you look back through time. The challenge is that will, as I think people understand, will put more pressure on growth, right? But it's the only solution that they have, because the biggest risk here, the biggest risk is that these central banks, having accepted elevated inflation for 5 years post COVID, ease into this oil shock, and then what are they going to do? Like, let long-term inflation expectations rise radically? There's no way they're going to let that happen. That would be incredibly risky for them to do. So they've got to nip this in the bud and make sure it doesn't have the second and third order effects through the prices on the
Mhm.
economy.
Yeah. I guess the big question that people are trying to sort out is, how forward looking and efficient is the bond market going to price this in? Because obviously, to your point, it makes sense for initially the short end of the bond market to begin to price in some hikes and some hawkishness. But you would expect potentially to see the long end begin to price in that, okay, well, look, we're having this oil shock and central banks are hawkish into it. If we're looking at a 10-year bond, maybe it makes sense to start to price in some negative growth outlooks into that. But so far we've seen the long end of the bond market sell off pretty significantly. I know you've been bearish bonds, bearish stocks, so I'd love for you to just explain how you think about how and when the bond market prices in these events and the sequences of them.
Yeah, I mean, the long end of the bond market, so far what we've seen is sort of the curve move up, basically, as this has happened. And if anything, what we haven't seen is we haven't seen a real expansion in risk premiums in the bond market through this event. And I think that's interesting because if you just sort of go back to um, what caused sort of a lot of the risk in the bond market, what caused the big lift in bonds was basically this transition in the post-COVID period, I should say. It was a transition from basically no one in the world ever considering that we would have elevated inflation ever again to a world where people are like, yeah, it can happen. We'll have elevated inflation again. And that forced essentially, some risk premium getting put into the long end of the curve into bonds. What I see now is that there's not people are sort of in that point where they're like, oh, they sort of have memory that inflation is likely to come down to central banks' targets over the course of the next year or two, not recognizing that inflation shocks can often have a life of their own. Meaning, like if you get an inflation shock into already elevated inflation, just go back to 2022. What did we see? We saw we saw inflation above these central banks' targets for 5 years, right? We were
Mhm.
year one into something that has played out for the last 5 years. Um, and and that was with massive tightening, right? A massive
Mhm.
rise in interest rates. Inflation is still elevated across every major developed economy relative to what central banks' targets are. So far, we have not seen a recognition that this could extend the life of that dynamic. And
Mhm.
so when I think about what's getting priced into the curve, what's notable is so far there has not been a meaningful expansion of risk premiums in the bond market that should create steepness in the curve, should create a sell off in the curve beyond basically just reflecting the fact that we need tighter monetary policy. And to be clear, that's true across the totality of basically financial assets in aggregate. Like risk premiums have not risen very much, despite the fact that we've entered possibly a new environment of elevated uncertainty, and yet it's hunky dory when it comes to how most investors are viewing financial assets at this point.
Mhm. So what's your checklist or signals to look for when to flip from being concerned about a hawkish central bank and inflation to demand destruction and negative growth?
Yeah, great question. And part of the story that creates the weakness in economic activity that comes from an oil shock is from the fact that interest rates rise. Again, important to recognize the ordering matters. Like
Mhm.
first interest rates rise, then there's a drag on the economy. And so what you need to see is you need to see interest rates on the long end rise enough, and to short end to some extent, but really on the long end, rise enough to start to create a hit to economic activity and also create a hit to asset prices, right, through the discounting effect. And so when I look at the market right now, you know, bond yields right now are basically where they've been for the last 6 or 9 months, right? The bond yields are like boring, right?
Mhm.
If you had just slept through the last 6 or 9 months, you'd be like, oh, well, we're basically where we were before. So we got to see bonds move to something that's going to be, create a more meaningful hit to asset prices in the economy. So that's moving up towards the 5 range, say on tens, in order to get a more meaningful drag. Now, I think part of the story here is that there's not a lot of the economy is very sensitive to those financial conditions. So I don't think you have to have bond yields go up to 6 or 7 or 8 or something like that to start to create the reversal. I think the cap is closer to 5 on 10s. And then at that point, that's probably enough of a drag combined with all the other things that we talked about to create, the subsequent downdraft in bonds. But again, the ordering I know it's hard to, it's easy to sort of get ahead of yourself on this thing,
Yeah.
but you've got to, like, linkages are ordered for a reason because they have that ordered effect on macroeconomic conditions. And so I think in some ways we've almost been like, so it's like we have a cancer of, of, it's like the cancer of QE, that people are like, okay, well then everything's going to be fine, right? So why should I ever worry about anything? And the answer is like, shit has to get bad before someone does something about it in order to make it fine. And
Hmm.
like, people are kind of looking through that has to be bad in order for something to happen, and just assuming everything will be okay forever. And that's just not how markets or economies have worked, certainly have worked over the last 100 years.
Let's take a moment to talk about Nexo. Nexo delivers a premier digital assets wealth platform designed to help clients build, manage, and preserve their wealth, earn interest on your digital assets, access crypto-backed credit without selling your holdings, trade with advanced tools, all supported by 24/7 client care. Now back in the US, Nexo offers new clients 30 days of exclusive Wealth Club Premier access. That means enhanced interest rates, reduced borrowing costs, and up to 0.5% crypto cashback on trades. Benefits typically reserved for Wealth Club members and private clients. Nexo is also expanding its global presence, becoming the official crypto partner of Tennis Australia, the organisation behind the Australian Open, and the digital asset partner of the Audi Revolut Formula One team. If you're ready to approach digital assets with a more structured wealth strategy, visit nexo.com/breakdown to get started. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
That's kind of funny. It just reminds me of like 2022 era when you were fighting the battle of everybody was, I don't know, freaking out about SOM rules and a recession back then. And you're like, look, like here where we are in the economy, the labor market's pretty good. Like we need to see the sequence of events to occur before we get to a point where things are bad. And it sort of feels like a mirrored situation here.
Right. That's right. That's I mean, maybe it's just it's just kind of a boring old macro person who, writes down this linkage and then this thing and then this thing, who studied too many cycles, who thinks in ordered, in order, in terms of how these things play out. But I think that that's part of the advantage. Part of the advantage, and the alpha opportunities that exist, is when people don't think in a disciplined way about the ordering and just
Mhm.
rush to one direction or one narrative or one intuition and away from another. I mean, look, when we look at what's going on with the pricing right now, like, financial the biggest thing, if you think about, sort of, from those folks who are trading markets, what's the biggest thing that oil shocks create? They create a hit on financial asset prices as risk premiums, as the Fed tightens, central banks tighten, and risk premiums expand. Right? That's what they do, and there's a long track record related to that. And so far, if you look at what's going on with asset prices in aggregate, stocks are basically flat and bonds are basically flat since this whole thing has started. Okay, so, like, that is the inconsistency there, which is that across asset markets, people are just not recognizing, one, that the oil shock creates this effect and they're rushing to the resolution down the line.
Hmm. Well said. All right, so I want to zoom out to the global economy and how this oil shock is hitting different countries, how it gets reflected in their currencies, and really divide it between countries that are importing energy versus energy exporters. Because you have Asian economies or the European economy that are big energy importers and especially acutely tied to the Strait of Hormuz versus a country like the US, which is nearly energy independent, has very little exposure and demand and dependencies on the Strait of Hormuz and what flows through it. And I would just love for you to unpack, like, how does that get reflected in the impact of those economies, and then how does that get shown in these currencies between energy importers versus exporters?
Yeah, I think it's been one of the most challenging circumstances this year is, um, for the first, whatever, 2 months of the year, the overwhelming narrative and market action was, rest of the world stocks doing well, certainly better than expectations, and the US trying to keep up and the dollar being a bit soft. And then we have this thing that happens that basically runs counter to, like, all of that underlying trend that had existed before. I thought we were going to talk about, de-dollarization when
Yeah,
when
exactly.
we originally scheduled this. It's going to be an update. on that conversation from last year, and it's very much the opposite for exactly the fundamental reasons that you describe, which is, look, Japan and Europe are in bad shape when it comes to big oil price rises. That's just all there is to it. They're across the developed world, they're very sensitive to these things. And other jurisdictions, particularly Canada and the US, are in a lot better shape to absorb these dynamics. And so it's not that surprising that we've seen one heck of an unwind of the foreign stock versus US stock story in response to this, as well as, some strength in the dollar. It's not a huge strength relative to what we've seen in the past, but it's still meaningful. And I think that's a combination of the fundamentals. Plus, I think a lot of people got caught off sides. People were kind of all in on one direction and got whipped back in the other direction. At this point, I look at things and I sort of say, look, broadly on a relative basis, whether you're looking at particularly when you're looking at stocks, we've largely priced in the differential effect of these dynamics. Japanese and European stocks have come back a ton, basically erased their gains for the year. The place in aggregate that doesn't make sense, I'd say, is around the aggregate pricing, meaning like aggregate stock prices across the global economy. Those have come down a little bit, but particularly when you add in the US, we haven't seen a huge hit to aggregate asset prices in the way that we haven't seen a quarter of the hit to aggregate asset prices that we saw during the 22 episode, even though the shock that we're seeing here is certainly on par with, maybe even a bit more significant. And then when it comes to currencies, the real risk in the currency market is, I think, again, it's largely played out as you'd expect from the fundamentals, with the dollar being favored relative to these other currencies. It is, the part of the story of what has driven these foreign asset markets is, a lot of U.S. investors looking elsewhere outside of the U.S. to more cheaply valued asset markets. If that really starts to unwind, you could create another dollar squeeze scenario, which would be very detrimental to asset prices in aggregate, somewhat foreign asset prices, but really asset prices in aggregate as sort of the dollar wins. And I know you guys have been talking about that in your weekly conversations. The dollar shock. We should not totally forget the risk of a dollar shock in this whole story. And you start to think about that from a risk management perspective, that you might have a lot of risk if the dollar pushes higher here.
Yeah, I mean, like, just if you take what's priced on central banks at face value right now, it just seems crazy to me that we're in a situation where, like, we could see the Bank of England or something hiking while the Fed is still on a cutting bias. Like, is there any evidence of that even being like something that occurs? Like, I can't even imagine the impact on currencies if that actually plays out.
Well, I think it comes down to where, like, the Bank of England or the ECB are going to be tightening aggressively in an environment where they're experiencing a hell of a external drag from rising energy prices, which is probably a way more important story for them than is the incremental monetary policy. I think often people uh, over focus on relative monetary policies as a story for exchange rate movements. Like, just think about it. Let's say the Bank of England tomorrow was like, we're gonna tighten 100 basis points. You're like, wow, that's a big tightening, right? Well, 100 basis points in yield terms is like a 1-day standard deviation in currency price terms. Like, if
Yeah.
you just think about it from a total return perspective, like, is irrelevant, right? It's why, like, central banks, if they're trying to maintain a currency peg, have to tighten, to 1,000% or something like that, because you have to be on an annualized basis, because you have to be at levels like that to change the underlying supply demand dynamic of an exchange rate. And so I think probably the relative monetary policy is just going to matter a lot less than the relative macroeconomic effects of the rising energy prices. And those are so disproportionately uh, in favor of the US and Canada to some extent, and negative for Europe and Japan, that's just going to drive those currents. That's going to be the much bigger driver of the exchange
Mhm.
rates ahead.
That's a good nuance. I like that. Um, the other thing I'm trying to tease out here from, if we have this potential tail risk of a major dollar rally, is contrasting that with the price action and potential for gold. When I look at everything that's going on, you would expect gold to rally pretty significantly here, I imagine. But since the shock, it's been bleeding. And I'm curious, how do you think about that? Is it largely something getting caught up short term in this dollar rally? Is it because positioning was so stretched into the shock, or how's gold playing out for you so far, and where do you expect that to go from here?
Well, gold is a financial asset. And so it's really important to keep that in mind. And so to the extent that there are, you're seeing elevated risk premiums across all financial assets, you would expect gold to be affected by it. And not only is gold just sort of generally a financial asset. And to be clear, if you go back and look at how it played out in 22, which I think is very helpful to see, like gold rallies initially and then it sells off a lot. Why? Because rates go up and all asset prices go down, and gold is just one of many assets, financial assets. And so it takes a hit just like everything else. Um, and so what's played out here, I'd probably put gold in this. The gold is like the macro equivalent of Japanese and European stocks for the equity allocators, in the sense of everyone got bulled up on these things. They generally made a fair amount of money on those things through the first 2 months of the year. And then all of a sudden, you have the shock. Everyone's bringing down their risk, and gold takes a hit, just like the European stocks and the Japanese stocks. From a fundamentals perspective, it's a little bit better situated than those assets, but it's still part of the sort of overextended positioning that came into this reversal. It's why, and when you take a step back, it's why, um, if you're building a well diversified portfolio of assets, it's why you certainly can't just rely on bonds to be your diversifier equities, which we've learned. But you can't also just rely on gold as a diversifier to your equities in addition to bonds, because in an environment of elevated commodity prices, gold underperforms like all financial assets, which is why you have to have commodities in your portfolio, right? And when I asked people, I was doing some CFA events a couple weeks ago. I asked people, how many people have commodities in their portfolio, and it's crickets. And they're like, well, commodities, they don't go up as much as stocks. Why would I ever hold them? Well, for this is the reason why you would hold them, right? Because there are going to be times when all assets are doing poorly because commodity prices are surging. And if you want to have some protection in your portfolio, that's why you have to have some commodity exposure within your portfolio.
Hmm. Well said. Yeah, I just want to bring this all together now in terms of when we look at all these asset classes and what they're reflecting. So you have the oil curve is pricing in something that's more significant than 2022. You have bond yields that are the same 6 months ago. You have equities that are largely flat. Seen small changes in currencies. Some pretty aggressive moves in interest rate pricing from central banks. Um, Gold's bled a little bit. Why do you think there's such a contrast or tension between all those asset classes right now? Is it just like a positioning thing, or people in complacency? Are they expecting a taco like Liberation Day? What's your read high level?
I think there's some collective amnesia about what's going on, what happened in 2022. And part of that is, I think folks have been sort of primed that there's always going to be the next easing and the next easing and the next easing. It's like, QE is like like there's all these burnouts on QE walking around, right? Thinking that they're just going to get the next, money hit coming. And this is very different from other shocks. Like, this is very different from traditional growth shocks,
Mhm.
where central banks are sort of all well positioned to ease into into a growth shock, into an external growth shock of some sort. It's a totally different environment. And so, um, the combination of sort of that sort of forgetting, conveniently forgetting about how 22 played out, and then also, this taco stuff is, I think people have really uh, gone hook, line, and sinker. I mean, for good empirical reason, let's say, for why taco. You should always be betting on taco in any fall is a good opportunity to buy. But again, a war is a very different thing than Liberation Day. Liberation Day was entirely determined by the, mercurial views of a single person. Meaning tomorrow, on the day after Liberation Day or 5 days after Liberation Day, like Trump could just change his mind and then magic, policy was different and things like he ran the taco shop. Today, the taco shop is jointly run by two big parties, but really like a dozen parties. And if they don't all agree that we're getting taco ahead, then no tacos will be served, to extend the analogy, right? And I think that's one of the challenges. Like, most people have not really spent a lot of time studying wars and their effects and things like that, because I mean, really, 75 years we basically had no wars, by and large. Like, small wars, not no wars, but basically small wars that didn't matter that much. But wars have a momentum of their own. And we're seeing that in real time in terms of how wars have a momentum of their own. And so it's going to take much more than just a simple, taco for this thing to get resolved anytime soon. And I think the oil market is really reflecting that, because I mean, people are down there counting the barrels. They're saying this many barrels in this, under this circumstance, in this circumstance, in this circumstance. And when they pencil out all those barrels, even assuming that there's a high probability that the U.S. is going to try and back down or have an off ramp or something like that, what is it, like a 60% chance the conflict ends within 45 days? That's a very high chance that a war ends within 45 days. Most wars take, at a minimum years, and often longer than years, to play out. When they add up all the barrels, they still have that curve where oil prices are 40% above where they are today. The problem is, it doesn't look like people in the equity market and the bond market are actually counting the barrels. They're lazily thinking about taco and QE and not thinking about the barrels and what the second and third order consequences are of those barrels. And so that is the gap. And these gaps happen in markets. This is why you can generate alpha from a macro perspective, because, not everyone is seeing the same reality and future reality at the same time. And so I think that's the gap we're seeing.
Amazing. Well, Bob, that's a great place to leave it. Some sage advice. Appreciate a lot. And yeah, great to just walk through these things. There's just endless whipsaws of news headlines right now. So I think it's a helpful mental model for everybody to digest and understand. So thank you for coming on and walking us through all that. I appreciate it. And where can folks go if they want to see more of your work in depth?
Yeah, thanks so much for having me. If you're interested in my sort of ongoing macro commentary, you can find me at Bobby Unlimited, anywhere you can find me, or check out my Substack, Non-Consensus, which you noted earlier. If you want to learn more about my day job behind me, check out unlimitedetfs.com.
Awesome. Well, thanks, Bob. Always good to have you on.
Thanks for having me.